Welcome back to the deep dive. Today we're jumping into the Colombo Stock Exchange, the CSE, really digging into the numbers for the week ending November 7th, 2025.
That's right. We've got the data, the reports, and honestly, it paints a really fascinating picture.
Yeah, fascinating and maybe a bit contradictory. We're seeing high risk, some pretty extreme concentration in certain stocks.
Exactly. And this kind of divergence between how the main indices are performing and, well, what's actually happening with trading volume, with liquidity. That's the core puzzle this week.
It really is. I mean, you look at the end of week numbers and things look on the surface pretty good.
They do. The S&P SL20 index, which tracks those big large cap stocks, it finished at 6381.47.
Which is a noticeable jump from the previous week's close of 62213.91. That looks like strong momentum, maybe growing confidence.
Confidence in some things, definitely, but like you said, that's just the surface. As soon as you peek underneath,
The picture changes.
drastically. And that's where we need to start the contrast between those rising indices and the actual activity level.
It's in a bit of a paradox. Okay, let's lead with that activity level then, liquidity. Because honestly, that seems to be the most striking signal from this week's data.
It really is. While the indices were climbing, the actual amount of money flowing through the market, the turnover, it just plummeted compared to the week before.
How big a drop are we talking?
Well, look at the total turnover. Previous week, it was over Rs, 30.73 billion. This week, it dropped down to just Rs, 22.91 billion.
Yeah, okay, that's nearly an 8 billion rupee difference. That's substantial.
It is. Now, we should add a small point here. The previous week had 5 trading days. This week only had 4 because of a holiday, right?
Okay, so that accounts for some of the drop, structurally.
It accounts for some, yes. But even if you adjust for that missing day, the average daily turnover was still clearly lower. The underlying interest just wasn't as strong.
So less trading activity day to day. And this is happening while the indices are going up. How does that work?
That's the critical question, isn't it?
Yeah.
When you see indices rising sharply on lower overall volume, it usually suggests the rally is, well, let's call it narrow. And maybe more importantly, it suggests it's brittle.
Brittle. Explain that for us. What does brittle mean in this market context?
Okay, think of it like this. High liquidity is like deep water. It takes a lot of consistent force, usually from big institutional players, to really move the market significantly.
Right, a stable base.
Exactly. But low liquidity, that's like shallow water. Even smaller players, maybe faster moving retail money, can create much bigger waves, disproportionate movements. So to push prices up dramatically in that shallow water, you don't actually need huge amounts of new money flowing in overall. A concentrated burst of buying in just a few key stocks can do it, especially if there isn't much selling pressure meeting it.
So this suggests the big institutional players, maybe they weren't the ones driving these gains. Are they pulling back or just waiting?
It strongly suggests a lack of broad institutional buying at these levels. They might not be aggressively selling. We'll look at block trades later for that. But they certainly are pouring money in across the board.
Which you would expect if this was a really solid, institutionally backed rally.
Precisely. You'd expect turnover to stay high, maybe even increase. The fact that indices are up while overall volume is down, that points towards maybe concentrated buying in index heavyweights, perhaps some rotation, but definitely not broad-based confidence from the big money.
And speaking of concentration, that RS, 22.91 billion turnover, where did that money actually go? Is it all in stocks? What about the debt market?
This is actually quite telling. The reports confirm that 100% of that turnover was in equity.
100%.
Yep, the corporate debt market. It reported 0 transactions for the entire week.
Zero.
Which tells you a couple of things. First, if you're looking for fixed income exposure on the exchange, forget it. Completely illiquid this week. And second, it just underlines that all the action, all the risk-taking, all the volatility, it was laser focused on the equity side. Stocks were the only game in town for anyone looking for capital gains, it seems.
That focus, that concentration, it really amplifies the index moves then, doesn't it? The S&P SL20 had strong gains for the week. And the ASPI, the all-share index, it even managed a 1.13% gain just on Friday, November 7th.
It did. And again, how does that happen with thin overall capital? It comes down to index weighting.
The big guys move the needle.
Exactly. Indices like the S&P SL20 are heavily weighted towards the largest companies by market cap. So if just a couple of those giants see big price jumps, they can literally pull the whole index up with them.
Even if most other stocks are doing nothing or even falling.
Precisely. It can completely mask underlying weakness or just general inactivity across the rest of the market. It gives you a potentially misleading headline number.
Okay, so the big picture. High index numbers, low liquidity. Let's look at who is actually trading. You mentioned the number of listed companies stayed the same, 284, but slightly more companies were traded this week, 284 versus 273 last week.
Yeah, that's another one of those slightly odd data points. More companies saw some trading activity, but the total value traded, as we know, dropped significantly.
So broader reach, but much less depth.
That's exactly what it suggests. More stocks got touched, maybe by smaller trades, but the average value per trade must have been considerably lower. One of the daily reports mentioned over 37,000 trades in a single day.
37,000 trades.
Yeah, that sounds like a lot of small, quick transactions, which often points towards more retail participation, smaller players jumping in and out. Hashtag tag 2, market breadth and sector extremes.
Okay, so let's shift from the volume to overall health, the sentiment. Market breadth advancers versus decliners. This should tell us if the gains were isolated or more widespread, right?
Absolutely. Market breadth is like the market's pulse check. And this week, the signals were, they were all over the place, really shifted during the week.
How so?
Well, look at Tuesday, November 4th. Early in the week, the advanced decline ratio, the AD ratio, was pretty weak. It was only 0.43.
Less than 1, so more losers than gamers that day.
Significantly more losers. That suggests negativity was quite widespread then. Even if some big stocks were holding up the index, most companies were losing ground. Fear was definitely in the air.
But that changed dramatically by the end of the week.
It really did. By Friday, November 7th, that AD ratio had jumped all the way up to 1.44.
Wow, from 0.43 to 1.44. That's a huge swing in sentiment.
Massive swing.
Huh.
A ratio of 1.4 means nearly 50% more stocks were advancing than declining by Friday. That signals a pretty strong surge of buying interest coming in late in the week, spreading beyond just the usual suspects, maybe into smaller caps.
Okay, that sounds positive for momentum, but hang on. There's a wrinkle here, isn't there? Even on that strong Friday with the 1.44 AD ratio, the ASPI data showed, 99 stocks contributing positively to the index, but 143 contributing negatively.
Yes, and that's such a crucial point. Thank you for bringing that up.
How can you have more stocks going up overall, the AD ratio, but more stocks pulling the index down? It seems contradictory.
It highlights the power of weighting.
Yeah.
The AD ratio tells you about the number of winners versus losers, the general mood, the momentum. But the ASPI contributors show the impact on the index value.
Ah, okay.
So even if lots of smaller stocks, which have tiny weights in the index, were advancing strongly on Friday, if the big, heavily weighted stocks were maybe flat or down just a little bit, their negative contribution to the index value could outweigh all those smaller winners combined.
So lesson 1 reinforced. Broad positive momentum doesn't always equal positive index performance if big players aren't participating.
Perfectly put. It shows that split, again, maybe retail driving enthusiasm in smaller names, while the institutions influencing the big index stocks are doing something else or nothing at all. A real bifurcation.
Let's talk about that enthusiasm, because some of the sector performance numbers this week were, well, frankly, they look unreal, especially looking at the daily returns for GICS Industry Group.
Unreal is a good word. They absolutely scream speculation. Just look at Friday, November 7th. Retailing, up 181%. Transportation, up 136%. Telecom services, up 115%. Real estate, up 110%. Food and staples retailing, up 103%.
181% in one day for the entire retailing sector group. I mean, if that was real economic activity, we would be shouting from the rooftop.
We would. But of course it isn't. This isn't about a sudden boom in shopping or shipping.
So what is it about? Why these specific sectors getting these insane jumps?
It often comes down to the structure of stocks within those sectors, especially in markets with thin liquidity like this. You often find companies in these groups with very small free floats, not many shares actually available to trade easily.
Right, illiquid stocks.
Exactly. They might have little or no analyst coverage. Sometimes they become targets for coordinated buying, maybe discussed on social media or forums. When the float is tiny, it takes very little money, relatively speaking, to push the price up dramatically.
So that 181% in retailing might just be a handful of buyers chasing one or two very illiquid retail stocks sky high.
That's almost certainly the explanation. It's pure momentum, completely detached from any realistic change in the sector's fundamentals. It turns investing into a bit of a gamble.
And we saw similar crazy numbers earlier in the week too, right? November 4th had consumer services up 131%, transportation again up 115%, retailing again up 111%.
Yes, the same themes popping up, often sectors linked to consumer activity or maybe infrastructure plays getting this speculative attention.
And on the other side of the coin, we can guess which sectors were not feeling the love by looking at the week's biggest losers. You had e-channeling, Lankum Dev, TJ Lanka, Lanka Ventures.
Yeah, those significant drops point to selling pressure or just a complete lack of interest in areas like perhaps certain finance companies, manufacturing, maybe some investment firms. It shows the market wasn't rewarding broad recovery. It was chasing these very specific, sometimes wild stories. #3. Volatility, top movers, and institutional fingerprints.
Let's zoom in on those extremes now. The individual stock, the top 10 weekly gainers really showcase that volatility we've been talking about. Some of these moves are just staggering.
Staggering is the word, top of the list. Senka Degala. It posted, get this, 143.91% increase for the week.
143% in 4 trading days.
Yeah. Its volume-weighted average price went from around Rs 679 the previous week to over Rs 1,656 this week. It more than doubled. Imagine trying to manage risk on a position like that.
It's less investing, more catching a rocket and hoping it doesn't explode.
Something like that. It's pure price momentum, not valuation. You also had Cotmail holdings up over 84%. Bogala Graphite up nearly 60%.
The Dockyard was up strongly, too, over 41%. And that one was interesting because it also had pretty high turnover on some days, right? Like ours, 292 million on Tuesday.
Good catch. Yes, Dockyard is notable. That 41% gain came with significant money behind it, suggesting maybe more genuine interest or liquidity there compared to some of the others that might have moved on very thin volume.
So when we see these kinds of massive jumps, 143%, and we know there wasn't some huge company-specific news or massive economic shift justifying it, what does it tell us about the mindset driving the market right now, particularly domestic investors?
It points to a real hunger for quick outsized returns. Maybe driven by things like high inflation eroding savings. People are looking for anything that might radically outperform holding cash.
So it becomes momentum chasing. Find something moving, jump on, hope to jump off before it turns.
Pretty much. It's often based on the greater fool theory. You buy high, hoping someone else will buy even higher from you. It's a very short-term speculative focus, far removed from analyzing a company's long-term value.
And of course, what goes up that fast can come down just as fast. The top losers list is the painful reminder.
Absolutely. E-channeling down 25% for the week. Lanka Ceramic lost over 13%. TJ Lanka down nearly 11%. It shows that if you guess wrong on the momentum, the downside is brutal and immediate. High risk, high reward, or high loss.
Okay, so that's the retail frenzy, the wild volatility, but then there's the other side. The big players, the institutions. We need to look at the crossings data, the block trades, to see what they were up to.
Yes, the crossings are absolutely key. They happen off the regular market order book. These are large, often pre-negotiated trades between big investors. They give us a glimpse into strategic institutional moves away from the daily noise.
And there were some significant ones this week, particularly early on, November 3rd and 4th.
There were. We saw some very large blocks in PICKME. One transaction alone was for 3 million shares at a price of 150.000 each.
3 million shares. That's a big commitment.
Huge. We also saw a substantial block in Singh Hospitals, over 2.4 million shares changing hands at Rs 11.00. And then you had big names like Aitken Spence and Commercial Bank also involved in multi-million rupee block trades during the week.
So what does it tell us when we see institutions doing these big deals in names like PICKME or Commercial Bank at specific prices, especially when overall market liquidity is so low?
It tells us that the big sophisticated money is still active, but they're operating differently. They're likely doing their price discovery and execution outside the volatility of the main market.
Trying to avoid moving the price against themselves too much on the regular exchange.
Exactly. If an institution tried to buy, say, 3 million shares of PICKME on the open market bit by bit, especially with liquidity this low, they'd likely drive the price way up before they finish their order. A crossing lets them execute at an agreed price efficiently.
So these trades confirm serious institutional interest and activity, but it's strategic, right? Shifting allocations, maybe taking positions based on longer-term views.
Precisely. Seeing blocks in a heavyweight like Commercial Bank might suggest portfolio rebalancing within the financial sector, maybe ahead of earnings or reacting to some policy news. It's a parallel track to the retail speculation driving Senkadagalo. The institutions are playing a different game, positioning serious capital, #4, investor behavior and macro context.
Okay, let's widen the lens again. Who's actually doing the buying and selling overall? Foreign investors versus domestic. What do the flows look like this week?
Well, the trend of foreign investors heading for the exits, that continued. We saw net foreign outflows consistently through the week.
Still selling.
Still selling. On Tuesday, November 4th, it was quite significant, a net outflow of around Rs 485 million. It did slow down a bit by Friday. The outflow dropped to about Rs 91 million, but still consistently negative. Foreign capital was leaving, not entering.
So, despite the indices looking strong, foreign investors aren't buying it. They're continuing to reduce their exposure. Why the disconnect? Are they seeing risks, maybe currency risk, political risk that local investors are just ignoring? Or maybe can't avoid?
It's probably a mix of things. Foreign investors have global options, right? If they're worried about Sri Lankan rupee devaluation or macro instability, they can sell and move their money elsewhere into dollars or other markets.
They have an easier exit.
They do. Domestic investors, maybe not so much. For many local players, the stock market might feel like one of the few places to potentially beat high domestic inflation. So they might feel compelled to chase returns, even highly speculative ones, just to try and preserve purchasing power.
So it reinforces that narrative. A market currently driven almost entirely by domestic sentiment and domestic liquidity, willing to accept risks that international players are actively avoiding.
That seems to be the dominant theme, yes.
Okay, let's put the CSE in a global context. How does its performance stack up year to date?
Actually, despite the recent volatility and liquidity concerns, the year-to-date performance is still remarkable. The CSE All-Share Index, by the end of this week, was up a whopping 46.37% for the year.
46%, that's huge.
It is. When you compare that across the Asia-Pacific region, it puts the CSE right near the top. I think it was second only to South Korea's KOSPI, which has had an absolutely blistering run, up something like 76%.
Wow. So Sri Lanka is still, in the grand scheme of things this year, a very high-performing emerging market, albeit clearly a high-risk one, too.
Absolutely. That context is important. The potential rewards have been massive, which maybe explains some of the willingness to chase momentum.
Now, how do global events filter down? Did any specific international news this week seem relevant to the sectors that were moving so much here, like transportation or utilities?
Definitely. You can often draw lines for transportation, for example. There were reports about U.S. airlines cutting capacity, maybe 10% on some routes, partly due to staffing or operational issues. Now, even if those cuts don't directly hit flights to Sri Lanka immediately, that kind of news creates a general sense of uncertainty around global travel demand, international tourism outlooks. For a market like Sri Lanka, which relies heavily on tourism, that sentiment can definitely dampen enthusiasm for related stocks.
Makes sense. And utilities, you mentioned that sector showing strength. Was there a global narrative feeding into that?
Yes, and it's a really powerful one right now. The energy demand linked to artificial intelligence, to AI.
Ah, the AI power crunch story.
Exactly. There was news about Amazon having issues securing enough power for new data centers in the U.S. And these forecasts that AI computing alone could double electricity demand in places like the U.S. by 2035.
So suddenly, boring old utility companies look like they're tied into the hottest tech trend on the planet.
Precisely. That global narrative can easily translate into local excitement. Investors start looking at local power companies, infrastructure plays, and thinking, hey, maybe they'll benefit from this massive future demand. It can fuel speculative buying, almost regardless of the local specifics.
Turning defensive stocks into growth stories through a global lens.
It can happen. And finally, just quickly, seeing positive news from global finance firms like Goldman Sachs reporting strong results, or tech firms like Palantir doing well, that provides a sort of positive backdrop for the local finance and tech sectors too. It shows profitability is possible even amidst global changes. #Tag5. Forward-looking insights and educational takeaways.
Okay, pulling all these threads together, the concentration, the crazy volatility, the foreign selling, the global stories, what should we be watching really closely in the week ahead? What are the key things to monitor?
Well, definitely keep an eye on those momentum leaders. That rotation into transportation, retailing, maybe some specific financials. Is that sustainable? Or does it fizzle out?
And the utilities.
Especially the utilities, given that AI power narrative.
Right.
We saw sharp moves Friday in stocks like Resus Energy up 8%, Panasian Power up over 10%. If that kind of targeted buying continues, it might signal a genuine sector trend taking hold, fueled by that global story, worth watching very closely.
And on the flip side, what are the biggest risks hanging over the market right now, given what we saw this week?
I'd highlight two main interconnected risks. First is simply that liquidity drain. We keep coming back to it. Turnover dropped sharply. The market is thin.
Meaning it wouldn't take much selling to cause a big drop.
Exactly. If sentiment sours, or if one of those big institutional players who did a crossing decides to sell a large block back into the open market, there just isn't enough buying depth to absorb it smoothly. It could trigger a really sharp, amplified sell-off. The low liquidity makes the market inherently unstable right now.
So the shallowness that allowed those big gains also makes it vulnerable to big losses. What's the second risk?
It's the unsustainable gains themselves. Those triple-digit percentage increases in stocks like Senkadela. Let's be honest, they aren't based on fundamentals changing that dramatically overnight.
Right, it's speculation.
Pure speculation. And that makes them incredibly vulnerable to reversal. For anyone new to the market, this is a critical lesson. Gains like that are often temporary bubbles. They can pop very, very quickly. What goes up like a rocket often comes down like one, too. Due diligence isn't just about the company. It's about the sanity of the price move itself.
That leads perfectly into our educational takeaways. Based on this week's roller coaster, what are the key lessons for investors, especially those still learning?
Lesson number one, which we've hit on a few times, is understanding the difference between index performance versus market breadth.
Don't just trust the headline index number.
Exactly.
Yeah.
A rising index like the S&P SL20 this week doesn't automatically mean the whole market is healthy. It can be dragged up by just a few heavyweights.
Yeah.
Always check the advanced decline ratio. If the index is up but the AD ratio is weak, below 1, the rally is narrow and potentially fragile. We saw that perfectly this week.
Check the breadth before you celebrate the height. Got it. What's lesson 2?
Lesson 2 is about decoding institutional flow, especially those crossings. Don't just see them as big volume numbers.
They're strategic signals.
They are. When you see multi-million rupee blocks trading hands-off market, like in PCKME or Commercial Bank, that's big money-making strategic moves. It's fundamentally different from the smaller, often faster retail trades driving daily volatility. Understanding why those institutions might be trading. Are they building a stake? Rotating sectors? Exiting? Gives you much deeper insight than just looking at the overall turnover figure. Institutional flow often signals longer-term trends. Hashtag tag outro. So to wrap it all up, the CSE this past week was really a tale of two markets. You had this surface layer of impressive index gains fueled by intense, concentrated domestic speculation in certain pockets, but underneath you had falling liquidity, continued foreign selling, and strategic, almost hidden, maneuvering by institutions through block trades. High risk, high reward, and very selective participation.
Which leaves us, and you, with a crucial question for the week ahead. We saw that even in this low liquidity environment, these incredible triple-digit gains are still possible in specific stocks. So is the next big sustainable trend already emerging? Could it be in those utility or infrastructure plays, genuinely catching that global AI tailwind?
Are these just the latest speculative bubbles? Fascinating to watch, but ultimately fragile and likely to burst when faced with the reality of thin liquidity or the next wave of institutional selling. It demands constant vigilance.
Vigilance and due diligence. That seems to be the message. That concludes our deep dive into the Colombo Stock Exchange for the week ending November 7, 2025. Thanks for joining us.
Always a pleasure.
We'll be back next week with more analysis.